Look, the financial industry spends absolutely billions of dollars trying to convince you what to buy. But when it comes to the exact parameters for capital divestment, actually selling those assets, honestly, it's mostly crickets, total silence. Well, in today's explainer, we're going to fix exactly that. We're diving into part 5 of the buy, hold, and sell blueprint, when to sell a mutual fund, the exit strategy.
Welcome to Bodhi Unified Flow. I'm your host, and here we are all about simplifying complexity and amplifying your performance. I am incredibly thrilled to walk you through this masterclass today because let's face it, having a solid exit strategy is a total game changer.
So what are we actually going to get out of this? By the end of this session, we're going to completely shift your mindset away from that emotional, panic-driven selling and move toward objective, strategic divestment. We'll learn how to spot those false signals that completely trap amateur investors. We're going to lay down the actual rules-based triggers for hitting the sell button, and finally, we'll navigate through the execution frictions. You know, those annoying things like exit loads, FIFO rules, and taxes that quietly eat away at your wealth.
Here is our roadmap for the explainer. We've got 5 main stops. First, the psychological trap, then false signals. After that, we'll hit strategic exit triggers, followed by navigating taxes and fees, and we'll wrap it all up with a quick summary and our references. Let's jump right in.
Section 1, the psychological trap, moving from pure motion to precise execution.
You know, financial markets basically just process human expectations, right? But our own cognitive biases absolutely ruin our returns. There's this huge, stark contrast between a reactive trader and a systematic investor. Behavioral finance tells us that as humans, we constantly fall for loss aversion. We literally feel the pain of a loss twice as intensely as the joy of a gain. And that leads to people just holding on to a falling knife, hoping it bounces back. But a professional asset allocator, they use a framework called breaking the attributes. To them, a sell signal isn't just some random price drop. You sell when the core fundamental reasons you invested in the first place are structurally broken. If your original thesis is broken, liquidation isn't just an option, it's the only logical move.
Moving on to Section 2, False Signals, how to hold steady through all that market noise.
Okay, to survive the noise, you really need to know what does not justify a sale. First up, short-term volatility. Look, a fund underperforming today might honestly just be out of sync with the current market cycle. Don't panic. Second, stop treating your mutual funds like browser tabs. Jump in constantly from fund to fund just to chase past performance. That adds zero value and totally destroys the magic of compounding. And the third trap, headline investing. Look, liquidating your hard-earned assets just because of a scary newspaper headline during a bear market, that is literal financial self-sabotage. Just don't do it.
Section 3, Strategic Exit Triggers. This is your actual blueprint for selling.
So, what are the objective, unbreakable rules for actually selling? First, you want to look for real structural degradation. This means consistent underperformance against a benchmark over rolling periods. Maybe a star fund manager suddenly exits, or there's a huge unapproved shift in the fund's investment strategy. Second, look at your own life. Are you just rebalancing to restore your original equity-to-debt ratio? Or maybe you're approaching a fixed timeline financial goal. If yes, then you sell. And finally, you gotta watch out for a notorious trap the industry loves to set, closet indexing.
So what exactly is closet indexing? Well, this happens when a fund grows way too large, or maybe the manager just gets overly defensive. They essentially just start mimicking the benchmark index. The fund's active share drops, which means your portfolio looks basically identical to a super cheap index fund, but you are still paying those massive active management fees. You're literally paying a premium for completely average returns. If you spot this in your portfolio, it's a massive, definitive signal to exit.
Let's actually apply this to a real-life goal, like buying real estate or funding your kid's education. Your exit has to be systematic. Imagine you are 36 months out. That's when you assess your timeline. Between 24 and 36 months prior to the goal, you want to initiate a systematic transfer plan, an STP. You start shifting capital from volatile equities over to stable, liquid, or debt funds. By the time you are 12 months away, your capital needs to be 100% shielded. Why? Because of something called sequence of returns risk. If the market suddenly crashes right when you need the cash, you're going to be forced to liquidate at the absolute bottom, permanently wiping out your capital. Section 4, Navigating Taxes and Fees. Let's talk about execution frictions.
You absolutely have to understand exit loads, especially if you're investing through an SIP. Most equity funds will charge you a 1% exit load for any redemptions made within the first year.
But guys, here is the huge trap that catches so many retail investors. Each and every monthly SIP installment starts its own independent 12-month fee clock. Thanks to the first in, first out or FIFO rule, if you decide to redeem your entire corpus after, say, 14 months, only the units from months 1 and 2 escape that penalty. All the rest, they get hit with that 1% fee.
And those STPs we talked about? Yeah, they have hidden costs too. While they are brilliant for safely shifting your assets around, you got to remember that the tax man is always watching. Every single monthly transfer in an STP is legally classified as a full redemption from the source fund. This triggers a capital gains tax liability every single month, and that slowly but surely reduces the capital base you have available for compounding. Anticipating these kinds of execution frictions, that is exactly what separates the amateurs from the pros.
Section 5. Summary and references. Let's make sure you've mastered this blueprint.
Just look at the incredible framework we've built today. We have successfully abandoned that emotional, loss-averse trader mindset in favor of objective, rule-based investing. We now know exactly how to tune out short-term noise and headline panic. Instead, we're only going to act on structural breaks, things like strategy drift, manager exits, goal proximity, and closet indexing. And crucially, we now have the tools to outsmart those sneaky operational frictions, like SIP clocks and STP taxation.
Now, to make sure you have the absolute best grounding, here are the foundational industry research and market text that inform today's detailed explainer. We've drawn directly from insights by Acumen Group, Bajaj Broking, True Data, Angel One, ET Money, and Value Research to bring you this comprehensive blueprint.
I want to leave you with one final, very important thought. I want you to go audit your own portfolio today. Ask yourself, are you holding on to an underperforming fund out of sheer blind hope and loss aversion? Or are you ready to break the attributes and execute a strategic rules-based exit? Choose wisely, because your future wealth literally depends on it. Thank you so much for joining me on this explainer, and I will see you in the next one.